Welcome back everyone to the second session of today. So in the previous session we looked at inventory. What is inventory? What is the difference between inventory on the perpetual and the periodic inventory system? And we talked about how to calculate the cost of inventory. So now, based on the principles of how to calculate the cost of inventory, I've given this revision question which we're going to work through now in order to cement what we've learned so far and to make sure you guys understand this. Okay, so the question says Rainbow Traders import desk chairs and assembles them locally. The periodic inventory system is used. The following extract of balances appear in the records as 30 June 2014, the end of the financial year. An inventory count at year-end revealed that there was inventory to the value of 60,000 on hand. Calculate the Rainbow Traders cost of inventory. Okay, so let's quickly go through the information together and see what was vital. Okay, so here they tell you we use the periodic inventory system. So now we know that when we do the cost of sales, we have to use that formula that we talked about, which was your opening inventory. Then we add our purchases, we add our import duties and any other cost, and then lastly we deduct the closing inventory that was based on stock take. Okay, so this is at the records. We are working towards a balance for 30 June 2014. Up here you would see the inventory balance was 1 July 2013, so that was the opening balance. Let's just write here opening. Okay, so the opening balance. And then we have an inventory count at year-end that revealed that there was inventory on hand of 60,000. So 60,000 based on the inventory count. So this would be our closing balance. Okay, I'm just going to write here closing. Okay, so let's see what other information that they give us, and then you can indicate in the chat function whether you would include it or not and at what value. Okay, so cash purchases, will we include it in our calculation of cost of inventory? And will we include it at 90,000 or will we include it at a different value? Cash purchases, will we include it? Okay, so Neil say we'll include it at 90,000. Tati say we'll include it at a different value. Okay, so we will include it, but it will be, this is before 5% trade discount, so before the discount was given. So that means we will take the 90,000 less the 5% is the value we will include it in. So Tati, you're absolutely correct. Neil, you just need to adjust it for the trading discount as well. Okay, credit purchases of 125,000. Will we include it? Yes or no? Neil says yes, we will include it. So yes, we will include that amount. Freight on purchases, will we include it in the cost of sales? Yes or no? Yes, we will include it. Import duties, will we include that amount? Yes or no? Yes, we will include that as well. Assembly cost of chairs. Assembling cost of the chairs, will we include that? Yes or no? Tato thinks no. Nick thinks no. Okay, Tato, Nick, let me ask you this. Will you buy a chair if it's still in parts? So if it's still in pieces, they haven't put it together yet. Okay, so based on that, do you want to change your answer maybe? So yes, we will include it. So remember, you need to think about a final product. So think about it as if you purchasing this product. And in what condition you would want that product to be before you acquire it. So think about it from that point of view, and then this will make a bit more sense, and it will be easier for you guys to determine what's included or not included. Okay, insurance while in transit. So this is the insurance we paid while we were busy transporting the raw materials to our location. Would we include that? Yes or no? Okay, so let me repeat what I said. This is insurance that we paid while our raw materials were still being transported to our premises. Is this maybe a cost that we've incurred to bring our goods to its present location? Yes, so because it's a cost that we've incurred to bring it to our present location before we assembled it, this would also be included for that reason. Okay, so it's very important that they told you while in transit. If they didn't tell you this, then it would have been a no. Okay. Purchase returns. Will we have to account for that when we work out our cost of inventory? Okay, let me rephrase it. When we return purchases, do we actually still have it in our stores? Okay, so based on that, do you think we might have to reduce the purchases amount to reflect the actual purchases we made during the year? I'm just going to repeat that. If we return goods, do we need to reduce our purchases to reflect the actual purchases we made during the year? Yes. So for that reason, this will also be included in your calculation, but we will bring it in as a negative. We will deduct it from our purchases amount to reduce the purchases to reflect the actual purchases we've incurred. And then the last thing we need to take into consideration is the closing inventory, but we're going to deduct it in our formula. Okay, so let's look at what should your calculation have looked like. You start with the opening inventory of 65,000. Then you've got your purchases, so it's the 90,000 less the 5% trade discount of 4,500 Rand. And then we add the cash purchases. Okay, to get to our total purchases amount. Then we deduct purchases returns. You could have also deducted it here at the top. It would have also been correct. Deduct 7,500. Then we add the import duties, the freight on purchases, the assembly costs, the insurance. We add all of those amounts to get to a cost so far of 298,500, and then we deduct the closing inventory to get to the actual cost of inventory of 238,500. Okay, do you guys have any questions on how we got to this answer? Is there anything I need to re-explain to you on how to calculate the cost of inventory, or is there anything that you are wondering about? Okay, so Zandila is asking, what is freight on purchases? So freight on purchases, Zandile, is the cost that I incur on transporting whatever I've purchased to my location. So freight is just a transport cost. That's just another word for it. Okay. Does that make sense to you? So freight on purchases is the name of the account we use in our accounting records, but it is basically a transport cost. So it can either be a ship that brought it in, it can be a truck that you put it on to bring it up from the coast to Pretoria or Joburg. It can be a little delivery van. It all depends on what type of mode of transport you use in order to get it in. You can even fly it in. So that's what freight on purchases is. So basically your transportation costs. Sandile, does that answer your question? Okay, any other questions regarding what we've done so far? Okay, so Tata asking, so if they say cash purchases after 5% trade discount, is the discount excluded? So if they say after trade discount, the discount has already been taken out of that amount, and you would just include that amount, Tata. You would not adjust it for the trade discount then. So to answer your question, yes, the discount would already be excluded from that amount. Okay, any other questions? Okay, so under the perpetual and the periodic inventory system, which system do you think is the best? So let's quickly recap what is the main difference between the two. The perpetual inventory system is basically a just-in-time system, so we know exactly how much inventory we have on hand at any point in time. The periodic inventory system, however, we only know how much inventory we have at year end, but the difference between the two is the perpetual one is a bit more expensive, whereas the periodic one is cheaper. Now, based on that information, which system do you think is best for a business, and why do you think so? So based on what I've explained, the difference between a perpetual and a periodic inventory system is, which one of the two do you think is the best inventory system for a business to use? Okay, so Tatu thinks perpetual. Why do you think perpetual is better than periodic, Tatu? Sandile says the perpetual because you know the value of the goods sold and on hand daily. Okay, Zile thinks periodic because it's cheaper. Nick thinks periodic because it's cheaper. Okay, I'm going to ask you another question, and then you guys, based on what you've answered, see if you want to maybe change your answer. Are all businesses exactly the same? Are their needs the same? No, they're not. Exactly. So do you think it will be dependent on what type of business we're talking about, which system might be the better one? Yes, that's absolutely correct. So actually, both systems have their pros and their cons. So it will depend on the company which one would be better. So both systems have certain advantages and certain disadvantages. So the perpetual inventory system would be the best to control your stock against theft, lost, or obsolete stock because you know exactly what your stock is on hand. So this is generally a better system for your big companies. For example, like Coca-Cola or Edgar's, your big companies want to know exactly how much stock they have on hand at any point in time. McDonald's would fall in there, Burger King, KFC, all of those big entities would generally fall in here. Whereas your periodic system has no suggested value of the inventory, so thus theft and lost or obsolete stock will not be detected until stock sale. But this one is a lot cheaper, so this option would be better for someone that does not have a lot of stock that moves during the year and for your small businesses. Okay, so for your smaller businesses, your startups, this would be a better option. Okay, now you can tell me what is obsolete stock? When we talk about obsolete stock, what is it? Okay, so Sandile is asking, is obsolete stock damaged stock? Sandile, no, it's not necessarily damaged stock. It can still be 100% functional and brand new. Think about fashion when you think about obsolete stock. So let's talk about Edgar's, or I don't know where you guys shop, Woolworths or Zanda or Zara. Let's think about those big chain stores. So currently, what would you find in the stores? What is currently in season? What is the latest fashion? Okay, so winter clothes. Is there specific colors that's currently in season? Okay, so Data says brown is currently in season. Okay. Do you think that this current trend will necessarily be the trend in 2 or 3 years' time? No. So obsolete stock is when your stock is actually still new, but you can no longer sell it in the market because no one actually wants to buy it because it's not what the latest trends or fashion is. Or another form of obsolete stock is, let's take a laptop. Because of the fact that technology advances so quickly, a headset that is now the latest trend and the greatest thing, in 2 years that stock would be outdated and a store will not be able to necessarily get rid of it. So that is what we call obsolete stock, stock that we can no longer sell. Okay, so it's generally stock that is still usable, but because of the fact that technology changed or fashion changed, it will no longer be sellable. So we call it obsolete stock and we write it off. Okay, does that make sense? Any questions on the two systems and why the one is not necessarily better than the other one? Okay, let's move on then. Okay, so now in your textbooks, you can follow on page 194 is the examples in your textbooks. We're going to go through this just to explain to you the difference between the perpetual and the periodic one by showing you a specific transaction and then how that reflects in both the perpetual and the periodic to help you distinguish between the two. This example is a very good one for you to get on top of how to account for the different ones in your journals. Okay? So if you lose me somewhere today, go back after class and go work through it again slowly until you understand this. This will be a good foundation to make sure that you know the difference between the two, that when you get to the test, it doesn't matter which one of the two they ask you, you will be able to do either. Okay, so the first one, ABC Limited has 18,000 units at 1 Rand per unit of product A on hand and on 1 April verified by a stock take. On 1 April, this was verified by a stock take on 31st of March 2009. The opening balance of the trading inventory on 1 April would be reflected in the general ledger as follows. Okay, so we are busy with the general ledger. So on 1 April, would there be a difference between the perpetual and the periodic inventory systems in our general ledger accounts? So based on the information they've provided, do you think there will be a difference between how you account for it in the general ledger on the 1st of April? Okay, so Tatu thinks no. Anyone else? Sandile thinks yes. Sandile, why do you think there would be a difference between the accounting for it in the general ledger? Okay, so the answer is there will actually be no difference between the two because of the fact that we did a physical stock take. So we know exactly what the balance is at that specific date. So because we did a stock take at the 31st of March, which is our year end, and we transfer that balance on the 1st of April, it will look exactly the same whether we've got the perpetual or the periodic inventory system. Okay, so you will see the balance brought down. This is our opening balance, would be exactly the same under the trading inventory account. Where the difference comes in between the two is when we start looking at the movements during the year. Okay, so that's where the main difference will come in. Does this make sense? Sandile, does this answer why it is a no? Okay, great. Okay, so the second example we have, ABC purchased on the 4th of April 200 products A at R1 per unit from Kiara suppliers. The purchase would be recorded in the cash book payments as followed under the perpetual inventory system. Okay, so when we purchase products on the perpetual inventory system, to what account do we take that purchase? Oh, sorry, it's 4,200 products at R1 each. Trading inventory, so that's correct. So when you look at your cash book payments, it will go to the trading inventory account. Okay, now because we did not actually tell you whether it's inclusive of VAT, I went with it's exclusive of VAT. We add the VAT on, and then it is the bank. So that was the original cost before any VAT was added. But in the test or in the, we will be very specific whether it's inclusive or exclusive of VAT. Okay, so that amount would go to trading inventory, and then we would be able to claim the input VAT on the amount that we physically pay, but we have to add the input VAT to get to the bank amount. Now, how will this differ on the periodic inventory system? What would be the difference be if we put it on the periodic inventory system? Okay, let's first say trading inventory, this is an asset account. So on your accounting equation, this would be under the assets. Okay, so Tatu said it would go to purchases. So let's go see, Tatu, if you're right. Okay, so under the periodic, yes, Tatu, you're absolutely correct. So we will take it to purchases instead of trading inventory. And purchases is an expense account that will go to it will decrease our owner's equity in the accounting equation. Okay, so if we've got an expense, it decreases owner's equity on our accounting equation. Okay, so you can see the only difference when we look at the cash book receipts is the name of the column. Okay, so under the periodic system, if we look at credit purchases, any returns on credit purchases, any petty cash journals, and the general journal, those differences would be exactly the same as if it would have been on the cash book payment. So instead of trading inventory with perpetual, we will have purchases for the periodic. Okay, so that is the main difference between the two. Okay, so I'm not going to go through all of those illustrations, otherwise I'm going to bore you guys to death today. Okay, let's look at the next illustration. ABC Limited sold trading inventory on the 2nd of April for cash. 2,000 units were sold according to the cash register roll. Remember, all goods are sold at a markup of 50% on cost. Now, if I tell you it's a markup on 50% on cost, cost price would represent what percentage?
$100.
That's correct, 100. Okay, so we would have 100 for the cost price. Our markup is 50. So our sales price is 150. Some people still got this markup stuff incorrect in the assignment. So if you're struggling with this, I need you to go back and revise it because they will ask this in your test. And I don't want you to lose any marks for not understanding what is the difference between on cost and on selling price. Okay. In Friday's class, if you're still struggling with those concepts, then come see me in the break so we can discuss it again to try and fix it before you get to your test. Okay, so how do we record the sales transaction in the cash book receipt for the perpetual inventory system? To what column will we take the information? And how many transactions will we record? So think back, cash book receipts. If I sell inventory under the perpetual inventory system, how many transactions do I have to record? Are we recording one double entry or are we recording two double entries? Neil says two, and that's absolutely correct. So what we have to do is we record both the sale. So this is the sale portion here. So we're recording the sale. And here we record the cost of sale. So I'm just going to say COS for cost of sales. Okay. So what you would see is because we sold 2,000 units, we take 2,000, multiply with 150 over 100 to get it to the sales price because they've given you the number of units was 1 rand a unit, remember? So we had the cost price here, the 2,000 units. And now we're converting it to the sales price, which is 150 over 100, which is 3,000 Rand. Then you add the VAT, which is 15%, which is 450 to get to a bank value of 3,450. And then the cost of sales in this scenario would be the initial 2,000. So in this scenario, they actually did it the other way around. They gave you the cost of sales value, and you had to go work out what is the sales value. Now this is transaction 1. And this is transaction number 2 that you have to record in terms of the perpetual inventory system. Okay? Under the periodic differ, what would be the main difference?
Ma'am, I think there's no cost of sales.
That is absolutely correct. So for the periodic inventory system, we're only going to record the sales transaction. We do not actually record the cost of sales. So as you can see here, there's no cost of sales column, so we do not record it. We only record one transaction, which is our sales transaction. Okay, so that is the main difference between perpetual and periodic. Any questions on illustration number 7? Things you are wondering about or something that I just need to re-explain? Okay, Zandile is asking, is the cost of sales recorded at the end of the accounting period? Zandile, no. We record the cost of sales for Okay, it depends on which one you're asking for. So under the perpetual, we record the cost of sales when we physically do the sale. Under the periodic one, we only record the cost of sales at the end of the year once we've done the stock take. So then we do a general journal to bring in the cost of sales amount. So that's a very good question. Does that answer your questions, Andile? So under the periodic one, we will only record it at year end. So let me just write it on here. So this is only recorded at year end. Okay. Make that a D. Okay, so if we look at the debtors journal, debtors allowance journal, it will be exactly the same as the cash book receipts that we've just done. So illustration 8 and 9 will be exactly the same. For those ones under the periodic inventory system, we also will not have a cost of sales column. So you can just go through your textbooks to just revise those specific ones. Okay, let's quickly talk about what is the main differences in the general ledger between the two inventory methods. So in our statement of financial position, your inventory in the beginning, so your opening balance, there will actually be no difference in your inventory account. But then there will be a difference as we go through the year. So in the beginning, so on your statement of financial position, which is our balance sheet, the inventory account amount will be exactly the same. If we look at the nominal account, so that is our income statement on our trial balance, the general ledger accounts will differ. And why do we say that? So under the perpetual inventory system, we'll only have your cost of sales column or line item, whereas under the periodic inventory system, we will have purchases, we will have carriage on purchases or freight on purchases or railway on purchases. So it all depends on how we get the goods to our location, custom duties, import charges, and purchases return. And each one will have their own separate general ledger account. Okay, so this is when we're looking at just the trial balance or just our financial statements. This would be the main differences. So there would be no difference in the inventory accounts because we do a physical stock take at year end. The balances will be exactly the same. It will only be on the nominal account, which is your income and expense accounts, will have differences on the expenses. Perpetual will only have a cost of sales account, whereas periodic inventory will have all of those various expense accounts that we will use to work out the cost of sales when we do our year-end procedures. Okay, any questions on what I've just said regarding the general ledger accounts on a trial balance or statement of financial position and statement of profit and loss and other comprehensive income? Do you guys have any questions on this slide? Okay, then we are going to start with question 6. We won't finish it in this session, and so we will continue with it in the next session. This is on page 209 in your textbooks. So if the picture quality is not sharp enough for you, then just use your textbook to go through as well. Okay, so let's quickly read through the information and then we can complete the Excel file of the specific information. Okay, so you are the bookkeeper of Ziyad Books. The business is a registered VAT vendor and trades only with registered vendors. Okay, The business charges 15% VAT on its sales, and all amounts are inclusive of VAT unless VAT is not applicable. Okay, so everything is inclusive of VAT unless otherwise stated, and VAT is 15%. As the bookkeeper, you have been provided with only the source documents for the month of August necessary for the preparation of the journals. The business uses the periodic inventory system. Okay, so this means we take it to the expense account. So purchases or the relevant, oh sorry, this is an expense account. Okay. All source document codes below, duplicate invoices, duplicate credit notes. So they're just telling you that they have all of the necessary source documents for all of these transactions. The business does not expect to award any settlement discounts nor to qualify for any settlement discounts. All occurrences of settlement discounts are therefore incidental in nature. Okay, so let's go through the first transaction. Bob Siat, the owner, so we know it's the owner, put in additional capital contribution in cash. In which journal would we place this? Okay, before we start here, let's quickly just check what is required from us. Okay, so Lino says in the CBR. Let me just write here CBR. Okay, let's quickly look what is required before we even continue. Use the relevant transactions given to complete the following journals. So we have to complete the following journals. Okay, so the first journal is your debtors journal, your debtors allowance journal, your cash book receipts, and your petty cash journal, and your general journal. So those are the ones we have to do. They indicate what columns you have to include. And yeah, in the cash book receipt, cash is banked on a daily basis. So that means every day we bank the cash. So our analysis of receipt and bank should be the same unless it is deposited directly into the bank account. And then they tell you clearly specify whether the VAT column is input VAT or output VAT. Okay, so we have to say if it's input or output VAT, and then all amounts are inclusive of VAT. Okay, unless otherwise stated. Okay, so let's just go back to the question. Okay, so the first one we said is a cash capital contribution in cash, which would go to your CBR. Okay, so that was correct, Lino. Okay, so this was a capital contribution of 96,000. So let's go fill it in on our capital cash book. So the first one, the first entry would be Bob Siat. We received 96,000 into the bank, and it is 96,000 going to our capital account. So these little marks here is just to indicate to you more or less what the mark allocation would have been for this type of question. Okay, this would actually be full mark. Okay, just hold on, let me just insert great symbol. Okay, normally for the account descriptions you would receive a full mark. Okay, so that is the first transaction. Sorry, that was not the slide I wanted to open. Okay. Then the second transaction, J. Lomu, sale of trading inventory. Now here you have, here the descriptions are a bit wonky again. So DC would be let me just quickly see, DC would have been duplicate invoices. So that would have been your debtors control, and DCS would have been duplicate cash slips. That would have been your cash book. Okay, so sale of trading inventory, this would be on credit to what general to what journal would you take this? So if DC relates to your debtors and DCS relates to your cash, what journal would we take it to? Okay, to DJ, that's correct. So DC 466 goes to DJ, DCS would go to CBR, Neil. Okay, so let's just do the second one. The second one would have gone to CBR. Okay, let's go fill this in. Okay, so J Lomo, we know it's on debtors journal, so let's go to the debtors journal. So we've got J Lomo. Okay, the amount based on the question is 95,200, and remember that is inclusive of that. So that would be recorded in our debtors control. So now we have to calculate the output VAT, which would be the amount from debtors control multiplied by 15 over 115, and then the sales amount would be multiplied with 100 over 115 to give us the sales value. Because we're busy with the periodic inventory system, you will see there is no cost of sales column on any of these three journals, okay? Because of the periodic inventory system. And then the second one we said is sale of trading inventory for cash for 88,600. So this one, the bank would be the 88,600. It would be both in the analysis of receipt as well as the bank because it was a cash slip. So we paid it on the cash register roll. And then we've got the output VAT, which is the 88,600 multiplied with 15 over 115. And the sales amount is 100 over 115. Okay, let's look at one more transaction before we take a break. Okay, so on the 12th, we've got M. Berg, sale of trading inventory. That would go to your debtors journal. It's 27,956 Rand and 99 cents, less 7% discount. At what value will you include this in the debtors journal? So I'm going to ask again, at what value will you include this in the debtors journal? Okay, so it says 26,000, Tatu says 26,000. Okay, let's go have a look. Okay, so when we complete the debtors journal, we say M. Berg. So yes, the two of you are correct. It's 26,000. So you take the 27,956,99 and we multiply it with 93%, which is the 100% less 7%. And then you multiply that with 15 over 115. Let me just increase the size here so that it's clear on the screen. And then we multiply to get to the output VAT. We take that 26,000, we multiply it with 15 over 115. And to get the sales value, we take the 26,000 multiplied with 100 over 115. Okay, so let's take a break here. Do you guys have any questions before we take a break? Otherwise, we'll continue with the question after your 10-minute recess.